Welcome to On the Sidelines, the show that discusses sports and how sports intersects our lives. I'm your host, Paul McGrath, and I'm glad that you can join us for this special show that deviates from sports, but brings us inside the sidelines of income taxes. On July 4th, 2025, a new United States Tax Act was signed into law. It is known as the One Big Beautiful Bill Act, or in some instances as OBBBA. How big is it? How beautiful is it? What does it mean to you or a business? To help you determine just how big and beautiful the tax law changes are, I am pleased to have with me my colleagues from the Westboro Accounting Office of Stowe and Degon. Prasanna Kandambi is the tax partner of the firm, and Westboro's own Mary Donati is our knowledgeable tax senior manager. When you throw me into the mix, we have 3 CPAs who have well over 100 years of experience. So let's see what we know. Prasanna and Mary, I again welcome you to On the Sidelines.
Well, thank you for having us back.
Thank you for having us.
Well, good to be here. So usually at this time of year, for the past number of years, it's just a checkbox, just a refresher. What's going on? Well, things have changed this year. I think we have some new things to talk about, maybe confusing things. I don't know. We'll see how big and beautiful it is to people. But what are we going to talk about? We have a lot to talk about. Who wants to start?
Yeah, I mean, we can talk about there are a lot of different changes, but there are also a lot of things that remains the same. So it's a continuation of some of the things that happened in the Tax Cut and Jobs Act in 2018. But we'll talk about how it impacts individuals and how it impacts the businesses.
Okay, who's going to start off?
Mary's gone first.
I am going to talk about, we're going to talk about the impact to individuals for the 2026 tax year due to this wonderful new bill. And as Prasanna indicated, a lot of these provisions that came about from the 2000 Tax Cut Job Act bill from 2017, a lot of these provisions were set to expire on December 31st, 2025. This bill has made a lot of these provisions permanent. And when we say permanent, that means they are the law right now. That's not to say that they're law forever, but the law right now.
Well, that was my question. How permanent is permanent?
Permanent is till there's a
So
new
temporary.
bill that...
It's just stay tuned, right? Yeah.
Yeah, permanent is till a new bill passes and is made a law, as the song says from Schoolhouse Rock, you know? So the big one that is touted, Mr. President Trump likes to tote, is that the individual tax rates are now, the highest level is at 37%. Believe it or not, this was something that was going to expire this year that would have brought it back up to 39%. This has now been made permanent at 37%, is the highest individual federal income tax rate. And another item that was set to expire this year that has a lot of implications to a lot of individuals was the child tax credit. That was going to expire. The TJ Act increased this to $2,000, and if it expired, it would have went back to $1,000. The big beautiful bill has raised this to $2,200 and has set an inflation adjustment each year, which is wonderful news for families. Of course, it will phase out based on your income limitations, but that is a wonderful improvement.
Now, how permanent is that one, theoretically?
Theoretically, into the next new law.
Permanent only means that there is no deadline when it's expiring, but till Congress decides to change it again, then everything is temporary.
Temporarily permanent.
Yes.
Okay.
That's what it is.
Carry on.
So one of the new things that took place with this big beautiful bill is there is a new deduction. It's a temporary deduction. It's only available for the 2025 through 2028 tax year. It's available for individuals who are senior citizens, meaning you're 65 or older, and this deduction is $6,000 per individual. And it does have a phase-out range that you may or may not be able to get. It is not available for those people who do not file jointly. So if you're married filing separately, this will not be available to you. This is in addition to if you are taking the standard deduction, it's an additional possible $6,000. If you're itemizing, it's a possible additional $6,000. So it's available whether you itemize or take the standard deduction.
So this is similar to the old exemptions, but the old exemptions are now
It's not an
permanently
exemption, it's an extra deduction.
extra deduction.
Yes.
Okay, all these terms.
All these terms, yes, it can be quite confusing. So the other thing that the Big Beautiful Bill did was raise the cap on the SALT limitations. The SALT limitation is your itemized deductions for federal and state taxes, real estate taxes, personal property taxes. Previously, they were capped at $10,000. Those were set to expire this year, and if they did expire, there would be no cap. But now the TCJ Act has placed the cap at $40,000. There is a modified adjusted gross income that figures into this cap. So for individuals who make between 50 and have AGI between $500,000 and $600,000, this cap will move lower and lower to $10,000. And if you exceed $600,000 in modified adjusted gross income, you are limited to $10,000.
So SALT is state and local taxes. Now, back in the day, we used to, when most people were able to deduct this, people would kind of bunch up if they could, and the taxes that were due in January, February, they would pay them. Is it time to look at that again?
Yes, you may want to look at it
may.
again.
It's again.
It's again, once again, if you're a person whose modified adjusted gross income is above $600,000, it
doesn't
doesn't
matter.
matter.
It wouldn't matter.
It does not matter. You are
But-
limited to $10,000, unfortunately. And
But for other people, yes,
Right.
that would be worthwhile looking into to
So
prepay your real estate taxes or pay your fourth quarter state taxes
Right.
before the end of the
Which
year.
was an old trick back in
Yeah.
back in the day.
Yeah.
So I guess we go here in Westboro, and I do not know the answer. Can we pay our real estate bill that's due February 1st? Will they have those out? Because I guess you have to pay based on a bill.
well,
Anyway, that's a
a
question
You'd
for
have
the
to
town,
call,
not for
yeah,
you.
You'd have to call the escrow company
Yeah.
and kind of figure out how to pay it. I'm not sure if it's as straightforward as that, but you're
Well,
right.
that's what it probably
You do need a bill. I think it's easier to pay state taxes ahead of time if
'Cause
it's
you can just throw in a number.
yeah,
Number,
you can
yeah.
throw in a number, yeah.
Yeah.
All right, carry on.
And then, of course, the mortgage interest deduction from the TJ Act of 2027 was limited to $750,000 of mortgage indebtedness. This has now been made permanent. So if you take out a mortgage, to say this year for $1 million, your interest will be limited to a debt of $750,000.
Also, you
There's-
can prorate it.
It is,
So
there is a
however they're
calculation.
going to do that, yeah.
There is a calculation that
Okay.
determines the amount that is deductible if your mortgage is above that $750,000 cap.
So again, more fun and games.
Yes, it is a lot more complicated
Right.
than it seems on paper, and you really do need to know the rules and how to compute these deductions. And then, of course, starting in 2026, PMI is back on the
PMI has kind of gone back and
fourth.
forth over
Yes,
the
so
years.
yes, so 2026 PMI will be able to be taken as a mortgage interest deduction.
Right, it's going to be added into,
Yeah.
is treated as if it's interest.
Yeah, and then quickly talking about interest, there is a temporary deduction for qualified vehicle interest for the 2025 through 2028 tax year. This is subject to your limitations based on your modified adjusted gross income, and the vehicle has to meet, the vehicle loan has to meet certain limitations accordingly, like the weight of the vehicle has to be secured by the vehicle. So that is available. There's something to talk to your accountant about, whether you have a vehicle you purchased this year with a loan that could qualify for this
I think
deduction.
I read also, part of it has to be made in the US.
Manufactured
It has to be
I don't know which
manufactured.
part is made.
Yeah.
It's going to determine all this, but
Yeah. Yeah.
I think the mortgage insurance premium deduction makes sense now because the prices of the houses have gone up so much that people aren't able to put in 20%
That's how
down
they have to,
anymore.
Yeah. And the big beautiful bill has made some tweaks to contributions. For those of us who cannot itemize, the above the line deduction is back for 2025 with a limitation of $300. This will increase to $1,000 in 2026 if you're single, and for married filing jointly at $2,000. This doesn't mean, I always get this from clients that call in, my donation is the amount that is allowable. The amount allowable is what you gave. Okay, you cannot go to any amount you want. There is no such thing. It is what you gave. Okay, subject to, of course, these limitations if you're taking the deduction above the line. But the big impact is starting in 2026, there will be what we call a haircut that could take place for those individuals who make contributions. And what this means is that the contribution has to exceed 0.5% of your AGI. That 0.5% will either be not allowed or will be allowed as a carry forward. It's quite a little bit of a tricky computation, so we suggest you talk to your accountant
And
about
AGI is adjusted gross
Gross
income,
income,
so we
yeah.
have to do that. So this year it's basically simple. Is
Simple,
it- so-
nothing has changed,
nothing
except,
but- oh.
except above the line deduction for those individuals who can't
Okay,
itemize.
so there's really, do you look to bunch up this year or not? Probably not, unless it's,
Yeah.
if it's 2,000.
2026, some
Yeah.
ideas, of course, are to bunch up in 2026.
26 next year,
Or
yeah.
once again, the last time we were on the show, we talked about qualified charitable distributions for individuals who are over 70 and a half. That's a good way to avoid this little situation, reduce your taxable IRAs by making contributions this way.
Directly.
Right, and that was I think when we discussed that, the contribution from the IRA has to go from the IRA
Directly
to
to
the
the
charity,
charity,
not,
yeah.
it doesn't come to you and over.
Correct,
Right.
it goes
So that
directly.
hasn't changed. Okay.
Yes.
Right. And just to clarify one thing you said, Paul, it makes sense to do the bunching in 25 when there is no haircut.
Right.
So that you're kind of saving that. So you could probably contribute to a donor advised fund
Right.
the next few years of contributions in 2025 so that in 26 and 27 or whatever, you're not taking those haircuts.
Yeah, but they didn't make this simple.
No,
Because
no,
you
no.
think, well, what's my adjusted gross income? Well, I hit the
No.
lottery on the last day of the year. Well, that throws
Yeah.
Yeah.
Anyway, you do the best you can based on what you know, and
Yeah.
we go forward.
Yeah. So once again, it is a computation for those of us, those who will be itemized in 2026. Okay. So we'll move forward to another itemized deductions that are will be subject to a computation.
Yep.
This is sort of goes back to a few years back. We had the P's limitation. This is not the P's limitation, but it is in essence a limitation for those people who are in the 37% bracket. Their itemized deductions will be subject to a possible 5.4% haircut, not being able to take certain
The full deduction.
the full deduction. And that starts in 2026.
Okay, so
Yeah. And then, of course, there are the AMT exemption and the related thresholds were made permanent. A lot of people aren't in this bracket, but if you are, this has been made permanent with the bill. And miscellaneous itemized deductions, those are your tax prep fees, your investment expenses. You know, years ago, these were allowable deductions. The TCJ Act suspended them, and they were set to expire at the end of this year. But unfortunately, the big, beautiful bill has permanently suspended these type of deductions. So you call in your accountant and saying, you didn't take my tax prep fee as an itemized deduction, my union and professional dues. Unfortunately, they still are not allowed.
and unfortunately, they probably need an accountant more now than they ever did
Yeah.
before.
Yeah.
Goes the other way, but
And the other thing that has taken place is the casualty losses.
Mm-hmm.
You know, the TCJ Act got rid of all casualty losses with the exception of casualty losses that take place due to a federal declared disaster. Starting in 2026, it expanded this a little bit to include disasters that a state has declared a state disaster. So it may not be a federal disaster, but it could be a state disaster. And if it's declared a state disaster, those casualty losses will now be able to be taken in 2026, subject to the casualty loss rules.
Okay, so that's next year.
That's next year,
Okay.
yeah. And
Okay.
once again,
So let's
it's
hope
quite
there's
complicated.
let's hope there's no casualties between now and the end of the year.
Yeah.
Okay.
Yeah. So educator expenses.
Yes.
For 2025, that will remain at $300 above the line. But starting in 2026, if you're able to itemize, you will be able to take more than that $300 limitation as a carve out for miscellaneous itemized deductions. Now, I just said miscellaneous itemized deductions aren't allowed in 25 and 26 going forward, with the exception in 26 going forward for educator expenses. And there's a whole list of items that are allowable expenses. And it also has expanded the definition of those who can take these types of expenses.
But this is if you itemize.
Only if you
Only if you
itemize.
itemize,
Otherwise, you're subject to that $300 cap per individual who may meet that requirement as an educator.
Okay.
Okay. So the big thing that was touted by President Trump was getting that qualified tip deduction.
Yeah.
And this is a temporary deduction. It's only available for the 25 through 28 tax year. It's a maximum deduction of $25,000. You have to be employed in an occupation that normally receives tips. It wouldn't apply to us. Unfortunately, as accountants, we don't normally receive tips.
We
but
should.
We
Yeah.
should.
So it's
We
basically
give out a lot of tips.
basically the hospitality industry is probably
Yes,
the
yes,
major
correct,
recipient
yes.
of this. Yeah.
And the tip has to be in cash. You cannot receive like a lottery ticket, wouldn't qualify. It's not a cash tip. And it has to be voluntary. So if you went to a restaurant and you were charged the tip of required tip of 20% because you had a party of 6 or more, that is not a voluntary tip. So that would not qualify as a qualified tip for this deduction. So it has to be voluntary.
Because there's many places now that basically charge 15% anyway.
Well,
It's a minimum.
They suggest,
But, yeah.
but if it's a required tip, it doesn't.
So it sounds like we're going to have more suggested tips next year, maybe, if you want to help out the employee.
Yes, yes.
Okay.
And the reporting requirements for 2025 are sort of ambiguous of how it's going to be reported on your W-2. It may be put into box 14. As we know, the IRS is on furlough. They're developing guidance for reporting qualified tips for the 2025 tax year. In 2026, the good news is there will be boxes on your W-2 that report this.
Okay.
Okay? And the other item, which was a big win for President Trump, was the overtime pay. And this, once again, is a temporary deduction for the 2025 through 28 tax year.
Permanently
And-
temporary. Okay.
And I forgot to mention this with the tips. These two deductions are not allowed if you are filing separately from your spouse. It's only allowed for head of household, single individuals, and married filing jointly. So if you're married filing separately, these two above the line deductions will not be available for you.
Okay.
And a quick example, a lot of people don't know what overtime is. And the overtime for this deduction is the Fair Labor Act standard law for the deduction, which is a 40-hour work week with the amount of being paid after 40 hours being 50%. So an example of this would be, let's say, Paul, that I am a normal person who makes $20 an hour. I work a 41-hour work week. My 41st hour, I would be paid $30. And that's where the confusion happens. Some people say, oh, it's $30, that's my qualified overtime pay. No, it's not. Your regular pay is $20. The overtime pay is $10. That gives you your $30. That $10, that is what's going to be the overtime for this deduction.
So it's the premium, in effect.
And yes,
if
yes,
we
you
can
could
put
see it that way.
Yeah.
Yeah. And there are a lot of nuances to this, so it's not as straightforward as
So
it
this
seems.
is, I assume, retroactive to January 1,
Yes.
just for the whole year.
Yeah.
So
Yes.
we've always said if you own a business, the best thing to do is get a payroll service, because the payroll service is going to have to take, who's going to keep track of all this stuff?
Well, I mean, if you had a payroll service, they should be keeping track
I would hope
of
so,
your
but-
overtime.
Yeah.
But there is guidance for 2025 because, you know, it is known that a lot of people still do their own payroll. So they're allowing an exception that you can use a sort of type of averaging to help employees figure
yeah.
out what their overtime is.
Well, the law was signed July 4th, so who
yeah.
was keeping track
Yeah,
the
so
first-
there is.
up till then?
That's a
Yeah,
fair
And
yeah.
even right after that?
Yeah, but if you are using a payroll service, you know, like ADP, Paychecks, even some of the smaller payroll services out there, they will have some type of system in
hopefully.
place that has been keeping track of this. And once again, there is no box to report this for the 2025 tax year. They are suggesting that it gets thrown into box 14 of the W-2. The good news is in 2026, they will be revising the W-2, so it does stick out quite nicely on the W-2, so taxpayers know how much their qualified overtime is.
I can see what some of the estimates are this year.
Yeah.
Maybe a little bit higher.
Yeah. So some other new provisions, there'll be above the line refundable credit for adoption. The amount that cannot be offset for adoption costs can be carried forward, you know, up to 5 years. 529 plan accounts deductions have been tweaked. K through 12 expenses have been expanded. The limitation has also been increased. Those are some of the bigger changes to the 529 plan accounts. And then the clean energy credits, those have gone away.
Gone away.
Gone away.
Don't even worry about them.
Don't even worry about, well, we can worry about
well, you worry
them
about
for some expenditures which will be expiring on December 31st, that are energy home efficiency credits, the residential clean credits.
Right.
Those are your solar panels, your geothermals. Those are still in effect for 2025, but bye-bye for
So if you put in
2026.
new windows, maybe this year, but
Not
Yeah.
next
get
Not
them in.
next
Hurry
year.
up. Okay.
Yeah, and the vehicles, as of September
Right.
30th, those electric vehicle credits, those are bye-bye too. So nothing really much has changed in the world of Massachusetts. The law is still pretty much the same. Some little tweaks are if you are a resident who has sold property non-resident who has sold property in Massachusetts, starting in August, you will be required to have withholding on those sales if they're more than $1 million.
Many states have that in effect.
Yes, Maine,
Right, and
California.
Massachusetts is a little bit late to the
yeah,
table here.
yeah,
Okay.
Maine and California have
Yeah.
had that in effect for years. Yeah.
So all those people who have moved to Florida but still own a property back
up
in
here, yeah.
Massachusetts would be impacted by it.
Yeah.
Yeah.
And this isn't part of the big, beautiful bill, but back in March of 2025, President Trump has made a executive order that says the U.S. government will no longer issue refunds or accept payments by check starting on September 30th, 2025. And this does have an implication to the taxes. Because if you're receiving a refund in 2026, in order to obtain that refund, you will need to give the IRS your routing number and your bank number. And if you owe money, you will either need to pay the amount owed through your software system. You can go online with the IRS. They have a wonderful site that you can make the payment. And the IRS also is developing other ways to make payment. So that will take effect in 2026. There are supposed to be provisions for exceptions to these rules for maybe the elderly, for those individuals who don't have bank accounts, because there are a lot of Americans who actually do not have a
Right.
bank account. There are also going to be probably exceptions to those individuals who don't have access to a computer, incarcerated individuals. We are waiting for the IRS to develop guidance for this, and this is one of those standstills due to a lot of these agents being furloughed due to the shutdown. You know, the exceptions to these rules have not been officially given to us.
Now, does this apply to my estimates? If I'm
Yes,
doing
it would-
quarterly estimates,
Yes.
I cannot
Write a check
You
anymore.
write a
can't-
check anymore?
No, you cannot write a
Yeah,
check
So
anymore.
everyone really has to go online to get an account, I guess.
You don't
Yes.
need, officially you don't need an account.
you
You
gotta
can
do
use their system.
use
There
their
you-
system. Good
Without
luck. Yeah,
set,
okay.
but I do
Yeah.
recommend setting up an
Yeah.
account with the IRS, because by setting up account, you are able to obtain an IRS PIN number, which could benefit you from scammers trying to impersonate you by filing tax returns in your name.
Now, and when is this effective?
It's effective right now.
So anyone
Going
making,
forward, yeah, for Q4 payments.
if you haven't,
Yeah.
you're gonna, whether you pay it now or in January. Now, but this is not Massachusetts.
No,
So
it's federal.
Massachusetts is just only federal.
Federal, yeah.
Massachusetts has wanted people to pay them electronically for a long time. They will take checks. Usually they don't like checks from businesses. They do want you to pay electronically.
Yeah. Well, usually, if you wrote the check, say an estimate was due on the 15th, you'd write it on the 15th, and you had some leeway in the mail.
Yeah.
Leeway is going out the window now. It sounds
Right.
like
Yes.
Right.
they're going to know when you pay.
Right.
Yes.
The other good thing about having an account is you can go back and look at all your historic payments. So you always have record of everything in there. So it just makes it a little bit easier.
So you'll be setting up your own account. In
You'll be
effect then.
setting, and the IRS account, it takes 15 minutes or so to set it up, because they kind of take a look at your license and they do face recognition for you. So they try to make sure that the person who's opening an account on somebody's behalf is really that person.
So where do I go? IRS.gov and
Yep.
try to
Yep.
Yeah.
find this?
Yes.
Yeah.
Yeah.
Yeah. So we should be doing it now.
Yeah,
Yeah. Yeah.
I think it's a good idea.
Well, especially if you're going to get a refund.
And like I said, if,
Yeah.
if you don't want to set up the account, the IRS is supposed to come up with alternate methods for paying amounts owed. And, it looks like they may be allowing individuals to go to the IRS office to make payments. Maybe they'll be having a center where you can show up and make a payment. I mean, it's being developed. We do know that through the IRS website, you can make an EFT payment without having an account. You could also pay by credit card now without having an account. I do not recommend anyone, of course, pay their taxes owed by credit card, because they take those fees on
There's a
that
big
credit
fee, yeah.
cards and they put it back to you, and it's a larger liability.
So right now we can go to the IRS, stand in line, and wait for a furloughed agent to come back and sit. Okay, carry on. Enough of that.
With that, we are kind of moving on to the impact of one big beautiful bill to businesses. The first topic is the qualified business income deduction. To just, without going through the numerical aspect of it, let's just talk through it conceptually. The qualified business income deduction was placed into service in 2017 when the Tax Cut and Jobs Act was passed. So you know how they reduced the corporate rates from 35% to 21%? So they wanted to do something for flow-through businesses as well. So what they did was they came up with this deduction. So normally, if you are an owner of an S Corp or a partnership and you made $100,000 in it, that $100,000 would flow to your personal tax return, and you'd pay tax on it based on your personal tax rates. This QBI deduction gives you an additional $20,000 deduction on $100,000 of income. So instead of paying taxes on $100,000, you really pay taxes on $80,000. So it only applies to like profits of the business.
Right.
So if you take some money like if you are an owner of an S Corp, but you take some money as compensation, this deduction doesn't apply to that. So this kind of, they try to make it a little bit even with the C Corps by giving this deduction. This deduction wasn't, they kind of classified two types of businesses for it. One is called the specified business and the other is non-specified business. This actually the specified businesses are usually the accountants, the attorneys, the professionals. They were not eligible for this deduction if they made over a certain threshold. That threshold was around $400,000 or so. They've made this QBI deduction permanent, but at the same time, they've also increased the phase outs for these specified service people. So the deduction, so the accountants, attorneys, etc., can take benefit of this deduction even with slightly higher income levels than before. That's what this kind of slide is trying to talk about.
So it's somewhat limited.
It's still somewhat limited.
I mean, it's
but
there.
for the-
It's better. It's
the
better.
change is a little bit limited.
Yeah,
Yeah.
but for the non-SSTB
Right.
people, it's still a great deduction.
Right.
There
Oh,
is
God,
no
yeah.
limitation.
Yep.
It's like a lot of the manufacturers, the distributors, the staffing companies, and all of these can take advantage of these deductions.
Okay, it's good.
The next one is the depreciation. The 179 rules were already pretty favorable. They made it even more favorable. You can write off up to $2.5 million worth of assets placed in service in 2025, 100% in year one. So you can pretty much write off the entire asset in the first year.
And the old definition to me was placed in services, plug it in.
Yes, yes.
That hasn't changed. Okay.
No. It does phase out once you've placed more than $4 million of assets into service
Right, they bring
in
it
a
down,
tax year. It kind of slowly phases out. The one good thing about Section 179 depreciation is that it's not only a federal depreciation, it's a state depreciation. Most states conform to it, and Mass conforms to it. So you can take the benefit for the state purposes as well. But if you're a larger business who doesn't have the ability to take Section 179, you can take what is called the bonus depreciation. Before the One Big Beautiful Bill, the bonus depreciation for 2025 was only going to be 40%. This has now been increased back to 100%. So you can write off 100% of your asset
So
in
one
year
way or
one.
the other, you're going to.
The only
able to
bad thing
utilize
about that bonus depreciation
Yeah.
as compared to 179 is that most states do not conform to it. Massachusetts also does not conform to it. So you'll not be able to write it off in a speedy fashion for state purposes.
Yeah, but the federal rate is probably higher than most states, so
That's
probably
true.
advantageous.
So it's still advantageous.
Right,
I agree. Yeah. The other thing to keep in mind is the R&D expense. This might not be applicable to everybody, but it did impact a lot of our clients. Back in 2018 or 17 when the Tax Cut and Jobs Act was passed, one of the things, how as a part of the appropriations, they're trying to create income in the future to take some benefits right now. So one of the things they had come up with was from 2022 onwards, all R&D expenses would be amortized over a 5-year period instead of being expensed immediately. So this is money that you've spent, but you're not getting a benefit of the deduction for it. Nobody thought this would stay for as long as it did, but there was, because of the deadlock in Congress, nothing was really happening, so nobody was able to ever go back and fix it. So the One Big Beautiful Bill kind of takes care of it. It allows people going forward to there are two ways. It looks at it in two different ways. For smaller businesses, they can go back to 2022, 23, and 24, and all those R&D expenses that they have amortized, they can now take a deduction right away. They can go back and amend the returns. Or the second choice that they have is that they can take all of that deduction in 2025, or they can split the deduction between 25 and 26.
So there's some planning to do.
There is some planning
you
to do
wanna
with
it.
regards
If-
to
if
it.
it's
So
somewhat
everybody has to
limited, yeah.
decide what works best for them based on their particular tax situation. There are people who have been negatively impacted by it for the last 3 years and have significant taxable income because of that. It probably for them it makes most sense to go back and amend and try to get that money that they've paid in back. For larger businesses, they can only do it prospectively. They can go back to 22, 23, and 24 and fix it.
Okay.
And this has been only fixed for domestic R&D expenses.
Right.
So if you're doing foreign R&D, the old rules still require you to amortize it over 15 years, and you have to continue doing that. So this is trying to promote domestic R&D, obviously.
Yeah, it's like putting a tariff on the foreign R&D.
Right.
In fact, okay.
Right. The other thing that might be a significant benefit is this new provision called Section 168N. What that is it's trying to promote manufacturing back in the United States. So if you purchase a commercial real estate that is being used for manufacturing purposes, you can take bonus depreciation on that and write off the entire manufacturing facility in year one. There are some rules and nuances to it. One of the rule kind of says that the real estate needs to be purchased by the manufacturing business,
entity.
by the operating entity. Most often, like real estate gets to be purchased in a different entity than the operating entity itself. So people are hoping that they'll fix that in like the corrections, in the technical corrections. But right now, the way the rule is set up is that you have to kind of purchase the real estate and use it for manufacturing in the operating entity.
So the brother-sister thing doesn't work.
Yes.
It doesn't work in this particular instance. The rule also says that you have to start manufacturing start the building that commercial space between January 19th, 2025 and between January 1st, 2029. And it needs to be placed in service before January 1st, 2031. So there is some opportunities for people to kind of plan
Look forward ahead,
to
yeah.
look forward and
Good.
kind of set up this manufacturing facility. So I think it's a great provision for manufacturing
Oh,
companies.
and here in the U.S.
Yeah,
Very good,
it'll make a significant difference.
And I think we'll see a lot of maybe places moving from one state to another. This is maybe a good, reason to leave a state that may be at a high tax rate for a lower a state with
Right.
a lower
That's a good
state.
point because states don't conform to bonus depreciation.
That's right.
So or every state conforms it in different ways.
Yeah.
Oh, you might get a bidding war here.
The other thing to keep in mind, this only impacts large businesses where previously the interest expense that you could take in a business tax return was limited to 30% of your EBIT, which is earnings before interest and taxes. Right. Now they have expanded it to include earnings. They call it using 30% of EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Okay. So it's a larger base, so you can take a more amount of interest expense deduction. Those are kind of the major changes with regards to businesses.
Well, I think that's enough.
Yeah, it is
It's a lot of
I think Stowe and Dagon's phone's going to be running off the hook because we don't even remember all the changes sometimes. And,
yeah, and the interesting thing is Mary constantly tried to talk about when things apply. A lot of things are applying in 25. There are a lot of things that are going into place in 26. So even we have to kind of make sure that we are kind of giving the right start dates on different things.
Well, yeah, what year you're talking about. And
yeah.
It's going to change.
Yeah.
All right, well, I think you've given enough thought to think about here. And just want to stay tuned. Some of these, they've got to get a little bit more definition on implementing them. But I think most of them, like you say on the tips, it's going to be an estimate. Yeah. So you do the best you can. That's all you can.
Yeah.
And any final thoughts, or just do the best you can and get your information in early.
That is a good point. Get your information in early. There's going to be a lot more questions and a lot more things to think about.
And I just want to also point out that we have a lot of clients who are always looking at what Google says in AI, and there are a lot of misinformation out there.
That's hard to believe.
So if you come across something on your the computer, it may not be correct. Like the other day, I came across something that said the teacher deduction for 26 was going to be $1,000. And I'm like, where did this number come from? And it's actually just the bill that's been proposed. It's not law. Yeah. So you have to be very careful about what you read on the internet.
I think the big thing I've learned here to help the firm is for the taxpayer, the individuals, to set up that account. Because I can see now people are going to, okay, they got to set it up, or they just want to pay the estimates. Well, how do I do it? And then come April 15th, everyone's saying, how do I do it? See if we can do that now and maybe get out ahead. Maybe get a letter out, let people know to get that account set up.
That's a good point.
Okay, well, I want to thank you and for coming on again. Hopefully, there's a little bit of a respite before it's going to be a big onslaught this year.
Oh, it's going to be a
There's
lot
gonna
of
be-
changes.
Whether you want confusion or not, it's going to be there.
Yeah.
So let's get ahead of the curve, do the best we can. I want to thank you for letting people know some of the tidbits, and hopefully they can learn from this.
You're a brave man for wanting to talk about taxes twice. Thank you for having us.
Thank you for having us.
Okay.
Yeah.
Well, this is Paul McGrath saying, hey, thanks for watching. Hopefully we got you inside the sidelines of taxes. But in the meantime, go to a game. And I hope to see you on the game, at the game. And if you're not in the game, I hope to see you on the sidelines.